Hello traders, and welcome back to the Forex Geek. In today's video we're going to dive into one of the most effective price action patterns in trading, and it is called rally base rally. So this is a powerful continuation pattern that, when used correctly, can help you catch significant moves in the market with precision. So whether you're new to trading or have been in the game for a while, understanding how to identify and trade this setup can give you an edge in your strategy. So stick around until the end of this video, because I will be showing you exactly how to spot these patterns, how to enter trades with confidence, and how to manage your risk effectively. So without wasting your time, let's get started. So let me break down the rally base rally. So this pattern consists of three distinct phases that form a powerful continuation setup in the market, or continuation structure in the market. So the initial rally phase demonstrates strong bullish momentum. So let me just illustrate that with the part 2, and has strong bullish momentum first. The initial rally, characterized by consecutive candles with minimal wicks, like a correction or a little minor pullback, and then after this consecutive pullback candles with minimal wicks and unclear directional movement, you now have a push to the upside. This is called the base. This correction is called the base, and it consists of about 5 to 15 candles depending on the time frame you are on. And finally you have the rally, the last push to the upside, and it's called the rally base rally. So you have the first rally, the base, and then the second rally. So the base phase emerges as the market naturally pauses to consolidate. So this crucial phase typically forms a rectangle or slightly tilted pattern. It could be a rectangle, or it could be maybe something like a triangle, where you could we are still going to go into the charts, and I'll show you this pattern. It could be a rectangle, or it could be a triangle like that, triangular pattern. So the base should be relatively tight, spanning no more than 30% of the preceding rally's length. So smaller body candles with longer wicks indicate the natural struggle between buyers and sellers during this consolidation. And then the final rally, which is this one, begins when price breaks above the upper boundary. So let me zoom into this. So let's say this is the upper boundary of your base, and when price breaks above this upper boundary, it means that the final rally has started. And this breakout should occur with increased volume and larger body candles, confirming renewed buyer interest. So the measured move from this breakout often equals the height of the initial rally. Exactly. Providing a clear target for position sizing. So let's go into the charts. Let me show you some examples of the rally base rally. I think I marked some out during my study, and you can see this one. So you have a rally, consecutive green candles, minor pullbacks, and on the higher time frames there will be no red candles right here. It's just be consecutive green candles. This is on the 1 hour time frame on GBP JPY, and you have this base indecision between sellers. See this wick, and buyers. So I'm just gonna zoom in here. You can see this wicks and indecisive movement here. Then you now have the second rally. So rally, the base, and the final second rally. You can see this is your base right here. So if I should shift this, this is our base right here. So this is a rectangular one, and you can see this massive breakout. That's a very good breakout to the upside without pullbacks or anything. It just broke out with consecutive green candles. So as you can see right there, this is exactly how it looks. And let me look for another example. This is another one. Have this consecutive green candles, then you have the base, which is this, and I could mark it as a rectangle, or I could mark it as a triangle. Mark it as a triangle right here. This was okay. This wasn't a triangle, like a wedge. So then we had the breakout. This was a very good breakout, and it shows enough volume in the market. If I should put the volume to check, I could put the volume to check the volume here, and you can see this consecutive buying volume right here, showing that yes, buyers are regaining control of this market, and this was just a rally-based rally, and that is how they form in the market, the rally-based rally. So just like a push to the upside, or consolidation, or a pullback, or a base. Here we call it the base, and then another rally to the upside. And this happens in an uptrend. It just shows that the buyers are taking a pause or a correction before continuing to the upside. So that is for the core of this pattern. Let me check for one more example. Okay, this was the start of a bullish trend, and you see this consecutive green candles, and then you have this base here, and then the breakouts. As you can see, the breakout is accompanied with buying volume right there, and then that is the rally based rally. So how can we use this rally based rally to trade? Let's talk about the trading strategy. Let me just go back. Exactly, this was the example I used. So let's talk about how to trade with the rally based rally. So the optimal entry for the rally based rally pattern occurs on the breakout above the base. So you wait for a clear close above the upper boundary of the consolidation zone. So to avoid false breakout, consider using a 1% filler. Only enter if price breaks 1% above the base high. So you can see this. After this rally, the base and the rally, you see the breakout right here. And we're breaking out of this rectangle. Price closed higher. So the entry point here should be above that breakout, and your stop loss could be below the low of the base formation, and you can target take profit levels of 1:1, 1:2, or anyone you want, or you could target resistance levels. Like this is a resistance level, and you can target that's a 1:2 trade, or you could raise your resistance level higher. Remember, you should always catch this in an uptrend, not in a downtrend. So it means that we are bullish, and after this base, price is expected to keep going up. It's expected, but it's not guaranteed. Nothing in the market is guaranteed. And this is for the other example. You see, after this push and close above the rectangle, you can see this is it. This is the rectangle right here. We closed above it, and this is the buy and the stop loss below the low of the base, and take profit levels could be higher at core resistance levels like this one, or you could increase any one you want to. You could use the 1:1, 1:2, or 1:3, any one you want, or you could use Fibonacci levels, Fibonacci extensions to gauge to gauge exactly where you can place your take profit levels. You could place your take profit levels here, which aligns perfectly with the resistance level. So anyone you want to, but there are multiple options for take profit. So that is for if you are an aggressive trader, that's one of the best ways you can enter. But if you are more conservative and you like to take a more conservative approach, and this means waiting for a retest of the broken resistance. Now, for example, this is a rally, the base and the rally. So it's expected that price should pull back to this support. Anywhere within this support, it could be the 50% of the support, or you can take the 50% of the support, like here, price retrace to the 50% of the support and push to the upside. So, or you could just place your entry at the top of this, at the top of that, your base, and your stop loss could be at the low of the base, but you should wait for a retest to that level. And a take profit levels could be at 1:1, 1:2, whichever one you choose, or you could target resistance levels. So, and let's look at this example. You can see price coming back to retrace. Here, price didn't come back to the 50% level, but price did come back and tapped back into this base. Extend this. You see, this was a worthwhile support level, and price started retracing from there and started giving us push to the upside. So do not try to bring your stop losses closer, because price could retrace deep into the base, into this support level. So always make sure your stop loss is below the base, and your take profit could be 1:1 or 1:2, and or resistance levels. And so that is one way. Let me look for another example. Okay, this is another perfect example. So you could enter after the close above the base, or you can wait for a retracement into, if you want to trade more conservatively, you could wait for this retracement, and you can see price giving us a push to the upside as we retraced. You could use a combination of other candlestick patterns like this engulfing pattern, or you could use the volume. You can see rise and buying volume after price hit the support level, or you could use the moving averages to confirm your trades. You could use the RSI also to confirm your trades, and here you just place your buy entry there, your stop loss under here, I take profit here, or take profit at that resistance level. And price didn't exactly get to that place, so that's why it's good to take partial profit. So you could take trailing stop losses, so that when price starts retracing like this, at least you could leave with some of your profits, and you won't give back all to the market. So that is how you can trade with the rally base rally. This is another example. Have a rally, the base, and the rally, and if you extend your base rectangle, you can see this was a worthwhile support. It touched it once here, about 3 times, one here, and one here. And this was another rally base rally, and this is your base, your rectangle, and you could take entries after the breakout, or you could wait for retracement. And this was retracement, and we had that push to the upside, and it happens, the rally, the base, the rally, you see the pullback into that zone, and we have the push to the upside. And this could be a rally, a base, a rally, but this base is too big, you won't consider it much of a base. And but we still had the pullback into that zone, that support level, and then the push to the upside. And that is how you can use the rally base rally to trade. Common mistakes to avoid will be chasing the initial rally. You shouldn't be chasing this initial push to the upside, because jumping into a trade too early during the first rally is not really wise, because price may not actually be bullish or be pushing to the upside. So you have to wait for that rally, the base, then that breakout. Because if you chase that initial rally, It often leads to entering at suboptimal prices and risking a pullback and maybe price hitting your stop loss. So another mistake to avoid is ignoring volume and price action. So you should always use the volume to confirm these trades. It's wise to use your volume. Like after you can see this breakout here, we had this rising volume, and also the entry at the pullback, you have this rising buying volume. So it's always wise to use volume and price action, candlestick patterns, and all of that. Another common mistake to avoid is neglecting risk management. So proper position sizing and stop loss placements are non-negotiable. Risking too much on a single trade or setting stop losses too tight, I've discussed this. Setting stop losses too tight can lead to account destroying losses or blowing your account. So another one is to another common mistake to avoid is overlooking support and resistance. So failure to consider key levels can result in poor trade, entries, and premature exits. So always be aware of significant price levels that could impact your rally-based rally setup. This base is a very good support level, and if you want to actually check that, you could use your Fibonacci to know if this retracement is in line. You can see the retracement falls in line with the 61.8% Fibonacci ratio, and that is one way you can validate your trades when looking for key levels, and it means that you are buying from a discount zone, and that is a very good way to trade. And another common mistake to avoid is forcing trades. So not every consolidation leads to a valid rally-based rally pattern. So patience is key. Wait for all elements of the pattern to align before committing your capital. So right traders, we've come to the end of today's video. If you found value in this video, please hit the like button and subscribe to the channel. Don't forget to turn on the notification bell to stay updated with more Forex trading insights and strategies. Your journey to becoming a proficient trader is ongoing, and we are here to support you every step of the way. So until next time, traders, happy trading.